right, let's get right into it. For what feels like weeks now, the story in the market has been pretty simple. A soft landing was just around the corner. But that whole narrative, it's shifted to something way more complicated. A fragile setup that some are starting to call a stagflation light economy.
So that really is the big question we're digging into today. Is that dream of a perfect, smooth economic soft landing? Is it just a fantasy now? Because the latest data is telling us things are far, far from simple.
And this is the core idea we need to wrap our heads around. Stagflation light. So what does that even mean? Well, it's this really tricky spot where economic growth is slowing down, you can see it happening, but inflation is just stubbornly refusing to cool off. And that leaves the central bank, the Fed, in a really tough position with almost no room to move. Which brings us to the first piece of this explainer, the stagflation light puzzle. The simple, clean story of a soft landing, well, for now, it's over. We've moved into a much more confusing and fragile environment. So let's see how this whole puzzle came together by unpacking the completely conflicting clues we got just last week. Seriously, it was a week that told two very different stories at the exact same time. Now, just look at the contrast here. It's pretty wild. Early in the week, the February CPI report came out, and it looked pretty constructive, right? Core inflation at 2.5%. The market thought, okay, great, disinflation is still on track. But then Friday rolled around, and the January PCE report, which is the one the Fed really pays attention to, told a totally different story. It showed core inflation at 3.1%, and that is just too hot for the Fed's comfort. And while all that was going on with sticky inflation, the other side of the equation, economic growth, was clearly getting weaker. We saw consumer spending basically stall out. We saw the job market soften. And at the same time, people started saving more, which is usually a sign that consumers are getting a little bit nervous. So you can imagine, at the beginning of the week, with that friendly-looking CPI report, the mood was optimistic. Risk assets rallied as everyone held on to that soft landing story. And then, bam! By the end of the week, the whole picture had flipped on its head. That hot PCE data, combined with a new oil shock from conflict in the Middle East, sent the S&P 500 down 1.6%. All that optimism was gone, and it was replaced by this new stagflation light worry. This whole messy situation puts our main character, the Federal Reserve, in a real state of policy gridlock. I mean, they are truly, truly caught between a rock and a hard place. And this right here illustrates the core conflict perfectly. On one hand, you've got the administration looking at new trade tariffs, which could raise the cost of all sorts of imported goods. And on the other hand, you have the Fed, whose entire job right now is to fight sticky inflation with tight monetary policy. I mean, these two goals are working directly against each other. And it's not just stuff happening at home. The Fed is also juggling these huge external pressures. The conflict with Iran is disrupting a critical waterway for oil, pushing prices up over $100 a barrel. You add in the tariff uncertainty and the fact that growth is weakening while inflation's still high, and you can see why the Fed has very few good options left. Okay, so with all that as the backdrop, what do we watch for next? Because there's one specific clue coming this week that could honestly change the entire story. So here's a quick look at the calendar. We've got manufacturing data, jobless claims, and of course, the big one, the Fed's interest rate decision on Wednesday. But one of these reports is way more important than all the others for what happens next in the market. And here it is. The real pivot point for the entire week is the Producer Price Index, or PPI. And it's the timing that makes it so critical. It's the last major piece of inflation data the Fed, and all of us, will see before that big Wednesday announcement. And you really can't overstate the stakes here. A soft or low PPI number would be like a huge sigh of relief. It would suggest that hot January report was maybe just a blip, a one-off, and it would let the Fed sound a lot more balanced. But a hot PPI print would confirm that price pressures are building again, and that would force the Fed to keep its tough, hawkish stance against inflation. So that brings us to our final section. In this kind of uncertain environment, with so much riding on one report, how should you even think about navigating the market? Well, the general takeaway is to lean a bit defensive. Sectors like industrials and healthcare are favored because their earnings tend to be more resilient. Energy stocks can act as a smart tactical hedge against that oil shock. And financials, they look a little less attractive in this kind of environment with slowing loan growth and rising uncertainty. And here are the key risks, the tripwires, to keep on your radar.
The biggest danger is that the energy price shock doesn't just stay at the gas pump, but it bleeds into the cost of everything else. And of course, there's the constant threat of new tariffs. We're just more data confirming this whole stagflation light dynamic.
But hey, it's not all doom and gloom, right? There are definitely paths to a better outcome. A good, benign PPI report, followed by a balanced message from the Fed, could restore confidence pretty quickly. And of course, any sign of de-escalation in the Middle East would immediately ease that pressure from oil prices. So to sum it all up, this is the new reality. The market regime we're in isn't that clean, soft landing we were all hoping for. Instead, it's a more unstable, more challenging mix of sticky inflation, slowing growth, and a central bank that has very few easy choices left. The real question is, how long will this stagflation-right environment last?